Good morning, everyone. I'm Mark Phillips, and I'm here at Harvested Financial, and we are looking at the markets today on Wednesday, February 10th. Well, what do we have here? Let me just pull up where the markets are at right now. We've got SPY trading up $1.64 at 391.96. That's 41 basis points. We have the VIX down barely a penny in cash at 21.62. We have IWM trading up a buck also, 229.42. We have the Qs also up a little over a buck at 334.65. Markets continue to drift up, and we continue to see all-time highs happening across the board. But this week is exciting because it is earnings week. And what do I want to talk about here on earnings week? Well, I want to talk about Uber. We are Wednesday. We are looking at butterfly strategies. Butterfly strategies are an amazing way to think about earnings strategies. So we asked the question, will this delivery service or will the delivery service revenues keep this rideshare company moving? It is a big question because as we looked at the third quarter earnings that were released last year, it was Uber Eats that completely saved the company. They had massively dwindling rideshare revenues. I believe they were down over 50%, but it was the 125% jump in delivery Uber Eats that brought that out. So a couple other headlines that we were looking at here. Of course, like I mentioned, they had their earnings announcement post-close. Like I said, they had their revenue boosted by all this delivery action. Everyone's staying at home. Pandemic business line is booming for them with Uber Eats. Finally, one thing that we're paying attention to here is that their competitor Lyft reported earnings last night, and they jumped 10% post-close. So we have seen some bullish action, and that has driven up the stock a little bit today. So in that vein, let's take a look at my screen share. So I'm going to pull up Uber. Got my trade hawk right here. We're going to look at the markets and we're going to find some ways that we can trade potentially a butterfly into the Uber earnings. So we are going to pull up the front month. We've only got 2 days left. Vol's trading at 125. Remember, we always like to say that vol for very short dated options isn't necessarily the best metric. We like to talk about straddles. A straddle that I'm looking at here is the 62 straddle. So it's trading around $5. 252 in the call and 238 in the puts, just under $5 for the straddle. So that means the market's pricing about a $5 move between now and the expiration of these options, which would be Friday. I think the bulk of that move is going to come as a result of the earnings. The earnings vol often represents a certain density in the surface because we know there is an event that is going to happen, and volatility doesn't necessarily decay linearly going into that event. It's going to decay in a very lumpy fashion after that event finishes. We know the variance is concentrated around this earnings event, so the move, if it's going to happen, is being predicted is going to happen tonight because that's when the announcement is. So $5 move, already decaying about a nickel since we started looking at this straddle. But looking at the 62 straddle, still trading just under $5. I'm going to put on a butterfly here for a defined risk. And I like making the butterfly width approximately the straddle width. So selling the 62 strike, we're trading exactly at 62 right now. I sell 2 of those. So remember, a butterfly is short the middle, long the 2 wings, gets you long a butterfly and short volatility. You're long because you're entering this trade for a debit, as we'll see in just a minute. So going for that $5 width, I'm going to go all the way down and I'm going to buy the, I'm going to buy, let's go for the 59.5. And on the upside, so that's 250 on the downside, and then on the upside, there actually isn't a 64 half. So you know what? Let's make this even. Let's do a 3-legged butterfly, and I will just remove the 59 half there. So we actually have a $6 wide butterfly, slightly wider. So 59, 62, 65. I call that $6 because there's the 59 and then there's the 65. $6 difference between them, with the middle strike sitting at $3 right in between. So this butterfly is trading, it's a relatively wide market, so it's actually about even at $1.15. So that's because that's a 30 cents wide market in the 62 that we have to cross and buy 2 or sell 2 of, and it's a 50-cent wide market in the 65. And it's a 30-cent wide market in the 59. So relatively wide markets here. It's going to be important, as I always say, execution quality, getting that in the middle of the trade. So we see this, $6 wide butterfly trading for midpoint of around 58, 59 cents. Optimistically, you can get this trade-off for 60, 65 cents, with some price improvement here. What is that going to look like? Well, I'm going to pull up my what if, and here we're going to see the pretty classic butterfly formation where we see the max profit zone right here if it sits at 62. So the most you can make on the trade is going to be the difference between strikes minus the price that you paid. So if you paid 53 cents is what this is modeling at here. That was about the midpoint when we staged and put this in the what if. So if you paid around 53 cents, you know, $3 would be the leg length there. $6 wide in total between the wings, but one leg where that max value is going to happen would be $3 minus the $53 that you paid, or 53 cents that you paid to get into that trade, which would make a profit of around 245, depending on all the slippage. This has the peak at 239, so around $240 that you could make if stock sits right here at 62. So uh, interesting defined risk way to play the earnings. There are lots of really interesting ways you can move around these butterflies. So really quickly, I can show you an example of using this as a price targeting mechanism. So instead of just saying it's going to sit here at 62, if you think it's going to go all the way up to 65, let's think about what a $6 wide vertical and compare the cost is there. So we're going to buy the 62 and buy the 68 against being short the 65. It looks a little uneven there, but it's just because of the additional strike listings. All of a sudden, that butterfly is only 31 cents. So a good 20 cents cheaper per contract to buy the butterfly. Now, your max profit is going to be up. You are using this for directional targeting and volatility coming in. So that's the reason that's cheaper, because right now the forward expected value of stock is right around 60. Well, now stock's down around 40 cents, but theoretically it's sitting right around 62. But if you're going to pick a strike that's further away from the money, you can combine that directional targeting and short volatility aspect to really leverage. You're still going to see the same $3 win per contract here, but instead of paying 55 or 60 cents to get into that contract, you're only going to pay 30 or 35 cents to get into the contract. So whether you're thinking that Uber is just going to sit where it is after earnings, or whether you think it's going to have a directional target, a butterfly strategy is an amazing defined risk way to put on that proposition. At Harvested Financial, these are the type of systematic strategies with defined risk that we're using every day to keep our clients exposed to the marketplace. Smash the subscribe button. We're here every day on Daily Bread talking about different opportunities. Wednesdays are butterfly days, so make sure you subscribe. Check out our playlist where we have all the butterfly strategies that we've been looking at over time. And in the meantime, check out our Twitter at harvested_DAFE, because derivatives are for everyone. Thank you for tuning in, everyone. I appreciate you watching, and